Welcome friends to the Bullish Money YouTube channel. It is time for another unfiltered session. So we had some big news that really wasn't so big. Janet Yellen decided to cave into the pressure and not raise interest rates to keep them artificially low and continue to perpetuate the financial engineering that her predecessor Ben Bernanke implemented during the onset of the Great Recession. So no matter what the media has said and no matter what the people have said, Wall Street have stated, nothing really has changed. There's this big hoopla that finally we have a woman sitting on the Fed chair, but she is just basically doing what all the previous dudes in that position have done. She has no balls, literally and figuratively, and it's just startling how much hype there is in this politically correct environment that we're in, that nobody seems to have balls. Nobody seems to have the courage to do the right thing. And while this may seem like it's going to be a good thing for the markets, it's truly not. And I said this before, that this hype about whether Yellen will raise interest rates or not raise interest rates, it simply wouldn't matter because the markets are fundamentally unsound. And here we go. I mean, right now it's about 40 minutes away from the closing bell at the New York Stock Exchange. We see that the Dow Jones Industrial Average is down nearly 2%. We see that the Nasdaq is down 1.37%. We see the S&P 500 down 1.64%. And so everybody was like pushing up the markets because there was this anticipation in the air. And then when most of the markets got what they wanted, which is to keep those rates low because we've got trouble in China, big trouble in China, and we have growing economic weakness in the emerging markets and a lot of currency fluctuations. The markets wanted to hear Janet Yellen say, we're going to keep this financial engineering, we're going to keep the quantitative easing going, we're going to keep that cheap, easy money, that cheap credit going. Hey, they got what they wanted. Wall Street got what they wanted, but it really didn't change anything because, again, you see that the Dow, the S&P, they're all down. They're all negative. And the Dow Jones specifically is back in correction territory. So all this up and down volatility that we've seen, all that effort, that huffing and chuffing by the bulls, we're back again in correction territory. And so when we go back from this time of the year back in 2014, we had a very similar circumstance. We had a lot of huffing and chuffing and a lot of questioning, what will the Fed do? What will the Fed do? And the Fed just gave Wall Street what they wanted, and we saw the markets, yes, they reached nominal record highs, but at the end, it really didn't matter because the markets then started crashing back down. Right now, this is a very dangerous time to start thinking that we're going to get out of this consolidation period back into the upside. Very dangerous because right now the markets are consolidating this information. They're absorbing the real fundamentals, and the real fundamentals say that there's nothing to be optimistic about. There's nothing to be positive about. And so regardless of what the supply side fluctuations that the Fed perpetrates, it doesn't change the fundamental picture. It doesn't change the foundation of the economy. This is not a sound economy that we have domestically. Internationally, you see that it is a complete mess. You see how much this cheap credit has destroyed the foundation, the infrastructure, the economic infrastructure of the global markets. And so the interest rate talk, all the speeches that the Federal Reserve gives, this is just buying time. This is just buying time for the Wall Street fund managers, all the social elites to get out of the markets and to stay in cash or precious metals or whatever the heck people are staying in. They're just staying out of the markets. There's no momentum in the markets. That's the big problem here. And the fact that we're having such a long consolidation when supposedly this is a very robust bull market, the fact that we're consolidating for weeks now, going back since mid-August, we're just in this massive consolidation period when supposedly we're so strong, we are the best stock market in the world. This is very concerning. This is very concerning because if the Fed has given Wall Street what they wanted, yet they can't get the momentum going in a positive trajectory, that means typically that there is going to be a harsh equilibrium coming, that for many years now, not just in over the past few months, but for many years, we have engineered a circumstance that is just not sustainable. And I believe in the coming weeks, in the coming months ahead, we are going to see a sharp correction of all that craziness that we have implemented into the global financial system. And we're going to start talking more specifically about the Federal Reserve and how they had a window of opportunity and how they blew it. That'll be coming up in the next segment. Interest rates at this point, this is just a one-sided transaction. This is just a proliferation of cheap credit. There's nobody on the other side of the transaction. It's like having a phone conversation with yourself. I mean, a phone conversation naturally means that there's one person on one phone, there's another person on the other phone. What good is it if you're just talking to yourself? And that's really what this whole deal is. And I think this is the reason why you're seeing the markets react the way that they're reacting today, because there's nobody on that other end. I mean, yeah, there's a lot of cheap credit, but if everybody else is so poor, they can't do anything with the cheap credit. Well, guess what? They're not going to actualize a transaction. You're going to get deflation. The reason why the Fed should at least get their hands off of the financial engineering is because of the condition where we are in today's economy, where we are in the markets. Low interest rates means, generally speaking, a period of economic growth or financial activity. That means that when you look at companies that don't offer high dividend rates, that's because the capital returns, the capital gains returns on investing purely on that stock should be great enough for investors to gamble on the company, and they'll probably make very handsome returns, because the company that's not giving out those dividends, they're taking whatever money they can get their hands on and reinvesting it back into the company, back into their business strategies, back into implementing growth strategies. So high-flying stocks typically won't offer high dividend yields. They just won't. Now, on the flip side, there are companies that are in mature industries, like tobacco, big tobacco. A lot of big tobacco companies like Philip Morris, they will offer generous dividends, like around 5-6%. It's not uncommon because their growth period has subsided. They're now interested in profitability. They really can't grow more than they've already grown. They're in a mature market. In a mature market, those companies that operate in such industries, they know that the capital gains returns on their stock, on their equity, is going to be very limited. I mean, yeah, they could go up, a little bit, but it's not attractive enough for investors looking to, gain some passive income. So in that sense, such companies will offer high dividends, high dividend yields. So that is an incentive. Maybe they won't get, sexy returns on the equity itself, but they will get consistent dividend payouts. And that's the big draw that the big tobacco companies offer towards potential investors. And in a similar vein, this is what we are in terms of the major indices, like the S&P 500, the Dow Jones. We're essentially big tobacco. The growth period in our economy has long subsided. We're not in those the crazy periods during the 80s or the 90s when we just got these just massive capital gains potential and returns off of the Dow and the S&P. Now we're just trying to eke out a living. We're just trying to just barely skate by. And so in that environment where capital gains growth is capped, we have to offer something to the investors. In this case, we have to offer high interest yields, because what's the point of investing in the US blue chip markets if the capital gains potential is limited to, and is known to be limited to everybody? Of course you have to raise interest rates. I mean, you have to give the investors something. You can't give the investors limited growth and limited dividend yields. That makes no sense. That makes no sense. And that's why technically I believe that the markets are collapsing. And I think that this is really just the beginning. I think as we move forward in the weeks ahead, in the months ahead, investors are going to be like, wait a minute, something's wrong here. You mean you want me to put up a bunch of capital and, maybe it'll beat inflation, maybe not, and I'm not going to get any reward for holding on to that risk? A lot of people will say, you know what, screw that, because at least I can take a risk on something as speculative as Greek debt and recognize that at least they'll give me high dividend yields on that. Or I can look at speculative companies, junk bonds, and get some returns. Or I can look again at companies like big tobacco and say, yes, they understand that their capital gains potential is pretty much gone, but because they know that they're gone and they're honest with it, they're going to at least give me 5 or 6% every year. And getting 5 or 6% every year is a heck of a lot better than getting 1 or 2% or going negative, obviously. So that's really the reason why the Fed should just let go of this whole financial engineering, because no matter what they do at this point, it really doesn't matter. But at least by letting go, you give the markets a chance to get true equilibrium. Now, they had a window of opportunity. They had a window of opportunity years ago when Ben Bernanke was still at the helm. He could have said, look, the S&P, the Dow, they've gained a lot of the valuation back. Now we should, instead of trying to go for the record, like fucking dumb Americans, we all go for the record. We need to get 2,000 points on the S&P. Instead of that attitude, that arrogant attitude, we should have just said, hey, at S&P 500 back at 1,400, 1,500 points, that's a good time to just kind of scale it back and not dive unnecessarily deeper into financial engineering. But no, we're Americans. We have to be the best at absolutely every little fucking thing. So S&P 1500, S&P 1600, S&P 1700, S&P 1800, S&P 1900, S&P 2000, S&P 2100. My goodness, when is enough enough? When is it time to realize that maybe our economy really isn't that sound? Maybe okay, great that the market valuations have gone up, but maybe we need to start concentrating on profitability of this country. Get some substantive jobs back to people who've earned it, who've deserved it, and make the concentration not just on pure speculative numbers, but make the concentration on GDP per capita. Make more Americans wealthier and in control of their financial future, rather than this, speculative, pissing contest that you see on Wall Street. Sadly, we've caved in to peer pressure, we cave into political pressure especially, so nobody wants to be the head of the administration that wants to bring back sanity. We want to continue to live in this insane world where America is the best at absolutely everything, and we're just going to keep churning and churning and churning until finally it just gets out of our hands, gets just completely out of control, and it just melts down. Well, yeah, that strategy works until the meltdown. That's the point here, right? This is the reason why I start ranting and raving sometimes, because I appreciate the strategy until it completely melts down. That's when I don't appreciate the strategy. That's when millions of Americans with pitchforks will not appreciate that strategy. And I'm just trying to prevent that whole, concept of pitchforks. What are you gonna do? Well, I guess you can just sit back, get your popcorn, and enjoy the show. Thanks again for watching another episode of the Bullish Money YouTube channel. Be sure to subscribe and also check us out on our social media network under the hashtag Bullish Money. We'll see you next time.